AI governance for financial institutions, and what the controls regulators now expect. The landscape of financial services is undergoing a fundamental shift. We are moving away from the era of experimental AI toward an era of mandatory institutional accountability. For the C-suite and the board, the 2025 to 2026 window represents a critical implementation gap. The grace period for learning the tech has effectively closed. Today, AI model risk is no longer just a technical hurdle for data scientists. It has transitioned into a core fiduciary liability. Global regulators, from the Federal Reserve to the Monetary Authority of Singapore, are no longer asking if you are using AI. They are demanding to see the specific, granular controls that prevent algorithmic failure from becoming systemic contagion. The cost of inaction is no longer just a missed opportunity for efficiency. It is the material exposure of the balance sheet, the risk of Pillar 3 disclosure failures, and the very real possibility of personal liability for senior management. This briefing explores the transition from theory to active governance, outlining the specific controls that are now a regulatory baseline for the world's leading financial hubs. The shift we are seeing is essentially the institutionalization of the black box. For years, AI was treated as a digital outlier. Now, it is being integrated into the traditional model risk management, or MRM, frameworks that govern everything from credit scoring to capital adequacy. But there is a difference. Traditional models were static. AI is dynamic. This creates a new kind of friction. If you are operating in the US, you are looking at SR 11-7. In Europe, it's Article 10 of the EU AI Act. In Singapore, it's the FEAT principles. Different names, but the same expectation. You must be able to explain why the machine made the decision it did. Let's look at the first pillar of this new reality: governance and the 3 lines of defense. In many institutions, the first line, the business units, have been moving faster than the risk functions. That is a recipe for a materiality assessment failure. Regulators now expect the board to have a clear line of sight into the entire model inventory. This is where model inventory automation becomes a necessity rather than a luxury. You cannot manage what you cannot see. If your institution is still using spreadsheets to track high-stakes machine learning models, you are already behind the curve. Wait, look at this for a moment. In 2024, a major European bank faced a silent model drift incident. Their automated credit limit AI slowly began favoring a specific demographic due to a data feedback loop. The board wasn't alerted until the compliance breach reached a level of systemic risk. This wasn't a hack. It was a governance failure. It proved that without a centralized automated view, the 3 lines of defense are just lines on a slide deck. From a boardroom perspective, this is about more than just IT issues. This is about your personal attestation of the firm's risk appetite. When you sign off on a Pillar 3 disclosure, you are stating that your capital charges are calculated accurately. If an unmonitored AI model is distorting those numbers, that is a fiduciary breach. You aren't just responsible for what the bank does. You are responsible for what the bank's algorithms do. The era of algorithmic plausible deniability is dead. This brings us naturally to the concept of operational resilience. We used to talk about uptime. Now we talk about logic stability. Under the Basel III frameworks, the resilience of a bank is measured by its ability to withstand shocks. But what happens when the shock is internal? What happens when a self-learning model starts making correlations that violate your internal risk policies? This is why continuous AI compliance monitoring is now a baseline expectation. Regulators in the UK and Japan are increasingly focused on the algorithmic kill switch. They want to know that if a model deviates from its intended purpose, there is a manual, human-centric override that can take the model offline without crashing the underlying service. But here is the real danger: the hidden risk. Most financial institutions don't build their own large language models from scratch. They license them. They use APIs. They use vendors. This creates a massive third-party risk management, or TPRM, blind spot. When you integrate a third-party AI, you are importing their biases, their data vulnerabilities, and their lack of transparency. Consider a recent supervisory finding in the US. A mid-tier investment firm integrated a third-party AI for sentiment analysis in their trading desk. The vendor changed the underlying model architecture without a clear notification. The firm's MRM team had no idea. The result was a series of trades that breached internal volatility limits. The regulator didn't fine the vendor. They fined the firm. They made it clear that your TPRM protocols must be as rigorous as your internal audits. You cannot outsource your liability. For the board, this means looking at third-party risk management as a core strategic threat. You must ask, do we have the contractual right to audit the training data of our vendors? Do we have step-in rights if their AI fails? If the answer is no, you have a hole in your operational resilience strategy that a regulator will eventually find. We need to talk about algorithmic transparency. This is perhaps the most difficult area for legacy institutions. Transparency doesn't mean giving away the code. It means explainability. In the Hong Kong and Singapore markets, the focus is heavily on the FEAT principles: fairness, ethics, accountability, and transparency. If a customer is denied a loan or a trade is flagged for money laundering by an AI, the institution must be able to provide a human-readable explanation of that decision. Staccato reality check. Regulators want proofs, not promises. Logic must be auditable. Outcomes must be repeatable. Bias must be measurable. One Japanese brokerage recently learned this the hard way. They implemented an AI for high-frequency market making. It worked perfectly until it didn't. When the regulator asked for an audit trail of a specific flash crash event, the firm couldn't provide it because the model's decision-making process was too opaque. They were forced to pause operations and overhaul their entire model risk management framework at a cost of tens of millions of dollars. The lesson? If you can't explain it, you shouldn't be running it. From the board's view, transparency is your best defense against litigation. If a model's decision-making is documented and aligns with a documented materiality assessment, your legal exposure is significantly lower. If it's a black box, you are essentially flying blind into a storm of class action lawsuits and regulatory fines. This leads us to the final, and perhaps most critical, area of focus for 2025. The move toward continuous AI compliance monitoring. The old way of doing things, the annual model review, is obsolete. A machine learning model can drift significantly in a week, let alone a year. The regulators in Switzerland and the US are now looking for real-time governance. They want to see dashboards. They want to see automated alerts. They want to see that your MRM team is getting a notification the second a model's performance deviates from its baseline. This isn't just about catching errors. It's about the Pillar 3 disclosure requirements. Your stakeholders need to know that your risk-weighted assets are being calculated by models that are under constant surveillance. This is where the integration of model inventory automation and real-time monitoring becomes the gold standard. It moves compliance from a once-a-year headache to a once-a-second competitive advantage. So, where does this leave the C-suite for the 2026 horizon? The transition to active governance is no longer optional. The firms that will thrive are those that view AI governance not as a cost center, but as a prerequisite for institutional trust. There are 3 priority actions every executive should take immediately. First, mandate a comprehensive materiality assessment of your entire AI portfolio. You need to know which models are low risk and which models could trigger a systemic event. Second, tighten your third-party risk management protocols. Ensure that your vendors are meeting the same explainability standards that you are. Third, move toward continuous AI compliance monitoring. Invest in the automation that allows your risk teams to see model drift in real time, rather than months after the damage is done. The 2026 regulatory horizon is approaching rapidly. The institutions that act now to bridge the implementation gap will be the ones that define the next decade of financial stability. Those that wait will likely find themselves explaining their inaction to a regulator or a judge. Executive summary for the board. The rapid adoption of artificial intelligence within global financial institutions has outpaced traditional governance frameworks, creating a significant implementation gap for 2025 to 2026. This briefing outlines the shift from discretionary AI oversight to mandatory model risk management, MRM, under global standards such as Basel III, the EU AI Act, and the MAS FEAT principles. For the C-suite, the risk is no longer merely operational. It is a matter of fiduciary duty and personal liability. Material exposures now include algorithmic bias, systemic contagion risk, and failures in Pillar 3 disclosures. Regulators in Tier 1 hubs, the USA, UK, Switzerland, Singapore, Hong Kong, and Japan, are shifting focus toward active governance. This requires institutions to implement continuous AI compliance monitoring, robust third-party risk management, TPRM, and model inventory automation. Failure to close this gap leaves the firm vulnerable to significant regulatory sanctions, loss of institutional trust, and balance sheet instability. The following strategic briefing provides the roadmap for transitioning to a state of permanent, automated compliance, ensuring that AI remains a tool for growth rather than a source of systemic ruin. If you found this strategic briefing valuable, we invite you to subscribe to the channel for more institutional-level insights into the intersection of technology, finance, and global regulation. Please like this video to ensure this content reaches other leaders in the financial community. And join us as we continue to navigate the complexities of the modern regulatory landscape.